Hello and welcome to my channel. Today we are going to look at the 60-40 investment portfolio. That's 60% stocks, 40% bonds. A lot of articles coming through the web lately about whether this portfolio is dead or alive, and it seems most people come to the conclusion that it is dead. But there is one big benefit to the 60-40, and I'm going to point out. We're going to back test a portfolio over the last 17 years or maybe 10 years and take a look at how well the 60-40 stock portfolio has done. But diversification is a popular strategy on Wall Street. Diversify, spread your dollars into multiple companies or buy an index. But why not include bonds? Why not have some of your money in a bond portfolio? So let's take a look. We're going to go backdate our portfolio. Okay, I have a chart of SPY. So SPY is a popular ETF that is weighted heavily on the S&P 500 index of about 500 stocks, and I believe slightly more than 20% is weighted in technology. But SPY, we're going to use that ETF when we go back and backdate our portfolio, our 60-40 split, and see how well it's done. So just taking a look at how it's done over the last 25 years. So SPY, so in 2007, it peaked above 155, and then in 2009 it bottomed out below 75, so it fell more than 50%. So it's a big deal when you're sitting on a basket of stocks and no stocks fall 50%. That's tough to stomach, especially if you have a lot of your retirement money in that. So it did it again in 2000, roughly beginning of 2000, over a 3-year stretch. It fell quite a bit, 50%. And most recently, if we look at the March 2020 low, so prior to that, the S&P was slightly over 320, and it fell below 260 for more than 30% drawdown. And again, when you're holding on a basket of stocks, and such as the banking sector, Bank of America, it fell from 35 to 17 and some change, 50% drop, and a lot of stocks fell 50%. So are we able to stomach that? And when we look at the 60-40 split, the 40% bonds is going to give us some cushion, or it's not as volatile just being as heavily invested in stocks itself. So let's take a look at what we're going to use for our bond portfolio. I have a chart of TLT. TLT is a government bond fund. It is 100% in U.S. Treasuries, long dated, 20 years. If we take a look at how TLT has done, most recently, if we look at it in the March 2020, when the S&P 500 index and most stocks collapsed more than 30%, 50%, 75% over a 3-week period, TLT was trading below 140 and hit a high of above 170. So why stocks are collapsing, what do bonds do, or government bonds? A lot of money is moving into government bonds to provide some cushion from the fallout of stocks. And going back to 2009, did the same thing. If we look at 2009, right here, when stocks collapsed, TLT rallied and went from the low 90s to almost 120. So when you have a mix of stocks and bonds, and the stock market collapses, and it's going to happen again, we know that. We don't know when, but it might be sooner than we think. A portfolio of bonds will help us cushion or stomach any of our portfolio that falls 50% or more. So let's go back and take a look at our portfolio, and we're going to backtest it over 10, 15, 20 years. Okay, so I have our model, our backtest portfolio asset allocation model. We're going to look at a couple different things. So we're going to look at two portfolio. One is the 60-40 split right here, 40% government bonds, and then 60% in stocks. Portfolio 2 is 100% stocks. And we're going to go back to 2007 and start with $10,000. So we're going to invest $10,000 in 2007 and see how well it's done in these two portfolios. So let's hit the Analyze button. Portfolio 1 is the 60-40 split. Portfolio 2 is all stocks. Let's see how well it's done. So pretty similar. Final balance the 60-40 split is slightly higher than all stocks. Compound annual gross return is slightly higher. Best year, portfolio 2, the all stock portfolio, was slightly better. Worst year, portfolio 1, the 60-40 split, was better. Now here's a big deal. If we look at maximum drawdown with the 60-40 split was less than minus 25%. The all stock portfolio, the SPY, was over minus 50%. That's a big deal when you have your retirement savings in stocks and they fall 50%. So if you're close to retiring and you want to be broadly diversified, it makes a lot of sense to include bonds in that, in your portfolio. So here's the growth over time, two charts, and pretty similar, small gap between the two, but since 2007, portfolio 1 has slightly beaten out portfolio 2, which is the all stock portfolio. But we can change the years around a little bit and manipulate it a little bit and get slightly different results. So let's just go back to 2003. So that's all the data on TLT or bond ETF. We'll go to 2003 and see if there's any difference. If we look at 2003, portfolio 1 is the 60-40 split, portfolio 2 is the all stock. So if we look at that, portfolio 2 does slightly better, but still the maximum drawdown is still over minus 50%. So it's easy to say we can invest in stocks for the long term, but when they fall 50%, it gets tough to stomach. Pretty similar over time, not much difference, except the drawdown, and that's the biggest advantage to owning bonds in your stock portfolio is the drawdown is not as much, and that is a big deal when it becomes to real life. So one thing I did notice here, 2020 has been a banner year for technology stocks or some other stocks that are driving the S&P pretty high, and that gap between portfolio 1, the 60-40 stock split, and just the S&PY is grown quite a bit at the end of 2020. So it's been real close throughout the last 17 years, but that gap has expanded in 2020, and that might be telling us something, that maybe stocks are getting overpriced and it's time for a pullback. But I don't know. And when it does pull back, if you have money in bonds, government bonds, then it won't be as bad. But there's other ways to play the 60-40 split. Right now, I really wouldn't want to be in bonds. Interest rates are awful low. They're probably not going to go much lower. That means bond portfolios, government bond portfolios, are going to fall. But I really don't know. My predictions are just babble. I can make predictions all the time, but if the stock market keeps rallying and going up and up in 2021 and bond prices fall and lose value quite a bit, then it might be time to start shifting money from stocks to bonds. It doesn't have to be 40%. It could be anything. It could be 5%, 10%, or 20%. So, or even 40%. You might want to shift slowly over time as stocks outpace bonds and that gap gets bigger and bigger. We might want to move more and more funds over into bonds. So there you have it. That's our 60-40 portfolio. It's done pretty well and pretty similar. Just 100% equities over time, except the drawdown is quite a bit less. So just recently, 2020, when stocks fell 30%, some stocks fell 50 or more percent, like Bank of America, it gets tough to stomach. So there you have it. If you like my content, you like my channel, hit the subscribe button and come back and join me soon. Thank you.